Hi folks, welcome to this short video on preparing a multi-step income statement. In part A of the question, or the first part, it was a little bit strange because they just wanted to give you practice calculating the tax impacts and the after-tax amounts when you're given pre-tax amounts. So, in our case, I'm going to focus first of all on item J and item O, only because they relate directly to a discontinued operation. You'll notice some of them in that list, specifically H and N, don't relate to a discontinued operation, so we'll explain them a little bit later. But now what I want to do is I want to focus on J and O. With J, it says here that we have a loss on operating a discontinued operation. And you'll remember that with a discontinued operation, gains and losses on it can be generated from two places. You could have a gain or a loss while you're operating your discontinued operation or your segment that you're trying to sell while it's up for sale. You can also, once you sell it, recognize a gain or a loss on sale. Well, in this case, while we were operating our discontinued segment, which was currently up for sale, it generated a pre-tax loss of $46,800 according to our question. That means we're going to pay less tax. Why? Because it generated a loss. We pay taxes when we generate gains, and we get a tax credit, or we reduce our tax expense when we have a loss. So in essence, our after-tax amount is less. So we have a lesser loss because the loss was reduced by the amount of tax that we save. So it's only $32,760. And again, we're getting the tax impacts when we take our 30% and multiply it by the pre-tax amount. That's giving us the taxes here. Now, if we had a gain when we sold the discontinued operation, that gain pre-tax was $79,200. We have to pay tax on a gain, so we're going to pay tax of $23,760 on that gain. So when we pay taxes, we're going to have a bracket, and that's going to mean that on an after-tax basis, our net gain is $55,440. With these other items, H and N, I don't want to go through them too much, but I do want to point out one thing. When you look at item H, for example, it does say there that the cumulative effect of a change in accounting principle resulted in a credit. A credit is a gain. So in this case, we have a pre-tax gain as a result of the fact that we've changed our accounting policy. Maybe we changed it from FIFO to weighted average when we were valuing inventory and calculating cost of goods sold. That can have an impact on income. In any case, it's going to increase income. So what does that do? When we have an increase or a credit, we have to pay tax on it. So multiplying this pre-tax amount by 30% gives us a tax effect of $45,360. So on an after-tax basis, we're going to have $105,840 as our after-tax measure. In item N, we overstated our previous year's sales. So what does that mean? You'll notice if you look at item N, they have that overstatement in the debit column, which means that should really have reduced income because our sales were too high. They're actually lower than we thought, so that would reduce our income. So when you reduce your income, you would pay less tax. So if our income had to be reduced by $36,000, that means we would pay less tax. So if we reduce income, that means our net reduction in net income on an after-tax basis would be $25,200. So in this question, when you see it in your online lab, you're going to see some of these. At least you'll know how to handle them. If they show you pre-tax credits, you're going to recalculate taxes and reduce that pre-tax amount to get an after-tax measure. If they're losses or debit balances, you're going to calculate the tax at 30% of that loss, right, or that debit balance, in order to reduce that debit balance or reduce that loss. Okay? Now, when you go to the multi-step income statement, again, we are going to use some of these numbers. Specifically, we're going to use item J here, which is a loss from operating a discontinued segment, and we're going to take this $32,760 as our after-tax measure into our income, and we're also going to look at the gain on the sale of the discontinued operation. Again, when you see the words discontinued operation or discontinued segment, or you sell a segment of your business, these are all items that have to appear on an after-tax basis. So we're going to use the after-tax measures here in our multi-step income statement. So in our case, if you look at the income statement, we're starting to prepare it with the name of the company, the fact that it's an income statement, and for a particular year, in this case, ended December 31st, 2014. So what are we going to show? Well, the question gives you a value for sales, so you have to start looking for the items that are going to show up in your income statement. And if you look at the chart that you're given, you see that you have sales of $2,329,200 and gross and cost of goods sold of $1,170,000 to give us gross profit on sales of $1,159,200. From that, we can deduct our operating expenses. We have operating expenses that we can identify here as depreciation expense on equipment and buildings. And again, these amounts are given to us in the question. And we also have a balance for other operating expenses at $234,000. If we add them all up, we're going to deduct our operating expenses from our gross profit on sales to get operating income of $709,200. From that operating income, we are going to deduct our other revenue or other expenses and add in other revenues and expenses. So now, if we look at the rest of the income statement here and the other revenues and expenses, we see that we have interest earned, which is a familiar account to you, and it's in our question of $28,800. Now, the gain on expropriation of land is something that's not familiar to some of you, unless you've looked at a previous video. If you're viewing this video before all the others, then I should explain this to you. Gain on expropriation, you see I've got a little item number 3 here. So if you go down to the bottom, let's look at what an expropriation really is by definition. What it means is that sometimes a government, sometimes it's a government in another country, they may have the right to expropriate or buy back from you any of your assets or your company, or any part of a business that you're running. Sometimes when you operate in areas where there is some political unrest, sometimes some more militant governments can do that. A little bit closer to home, we have similar examples of this, where maybe the city of Hamilton or wherever you live, they might decide that they would like to buy some houses because maybe they have a plan to put in I don't know, a hospital, or maybe they want to put in a highway and it has to run through that area. So they might make an offer to the people who own those particular buildings to buy them back from the people who own them. It could be the same even if it was a house, your home or something, right? They might want to build something there, maybe a park or something. But it's something that maybe a government wants to do, and they will make you an offer to buy back your property. So that's what an expropriation is. So if a company decides to sell its property back to a government, they can actually maybe be making money on the deal. And in this case, we have them making $68,400. Some companies have lawsuits. Sometimes a customer could be suing you for, maybe they fell on your property, maybe they had a car accident. So say you're a Ford Motor Company and a dealership fixed your car, and maybe the workmanship was faulty, and maybe they replaced a tire, it flew off your car, and it hit another car and it killed somebody or whatever. So you might have a lawsuit out against Ford Motor Company, for example. In some lawsuits, there are losses, and in some lawsuits, you might be suing somebody and you might win. So there's a gain from a lawsuit. In any case, we have the pre-tax gain and a pre-tax loss of the amounts that you're given here in the question. We also maybe sold some office equipment, and when we compare it to the carrying value, comparison to what we got when we sold it, we had a loss of $59,400. So when we add up these other revenues and expenses, we come up with total other revenues and expenses at a net revenue of $81,000. So when we add it to our operating income, we have income from continuing operations before tax of $790,200. So what do we do with that? We calculate income tax expense. In our question, they gave us the rate of tax that we needed to apply. So in other words, what we're going to do is to the $790,200, we are going to multiply it by 30%. So I'll just put in 30% here so you remember that you're multiplying this before tax amount or pre-tax amount by 30% to come up with $237,060. So you can see here that your income from continuing operations is always on an after-tax basis. Okay, and after tax is $553,140. So now when you add in your discontinued operation elements, now you have to remember to calculate your discontinued operations items on an after-tax basis. So this is when we have to go back to the calculation that we did above. Above we had our loss from operating our discontinued segment of $32,760 and our gain from selling the discontinued operation assets of $55,440. So those two amounts are going to show up on an after-tax basis in our discontinued operation segment. But remember, we always have to show the tax amount that we're deducting from the pre-tax amount to come up with this. Just like we have to show the income tax expense here on continuing operations income, we also have to show the tax amount from our losses or our gains as a result of discontinuing our business segment. So we show these amounts after tax, but we also have to show the amount of tax that we deducted from the pre-tax loss here to come up with this after-tax loss, and we also have to show the amount of tax expense that we had to pay and deduct that from our pre-tax gain to show the after-tax gain. And in our case, when we add these two amounts up, we are going to come up with an after-tax net gain of $22,680. We are going to add it to the after-tax income from our continuing operations to come up with full net income of $575,820. So this concludes our calculation for the moment of net income, including a discontinued operation. The next step we're going to do with this, and in our next video, we're going to practice calculating earnings per share.